We've got inflation inside the band, 6-month annualised at the middle of the band, and perhaps what has changed and is encouraging is that the balance of risks have shifted from being to the upside to slightly balanced, tilted to the downside even, and that's opening the door for these rate cuts.
We've learned that household consumption is softer than the RBA expected, and forecasts for economic growth have been revised to a more gradual expansion. When we talk about increasing downside risk, what is meant by that?
There's a number of risks in the economy, and that's always the case. But at the moment, we've got a few emerging risks that are highly uncertain, to be honest. Now, the most obvious one is tariff policy, where we don't really know where US tariffs are going to land yet. So it's difficult to work out exactly what the economic hit to global growth and to Australia will be. But we know it will give us a slightly weaker global growth tailwind, if you like, for the economy. Domestically, what we're seeing from households is that they've become very price conscious, even as disposable income is rising. And there's some evidence that they're choosing to save a bit more money than economists and the RBA had expected. So they're spending a little bit less into the economy. So again, we're just watching that saving versus spending behaviour very, very closely. Now, when we take all of that together and add in the fact that construction costs are falling, what we see is for inflation, the risks are tilting now for slightly more downside for inflation. We might even get inflation a little bit below the midpoint of the policy target band. And in that environment, you want to try and get monetary policy settings to what economists call neutral, which is a cash rate that's not stimulating the economy, but not holding back economic growth either.
And so does that mean, in your view, another cut is now likely at the next meeting in July?
I don't expect a cut in July, but we do expect a series of rate cuts to continue from here. We think that the RBA will wait until August for the next rate cut. And the reason for that is twofold. The first one is that the 90-day tariff pause for countries except for China ends just a few days after the July board meeting. And we think the RBA will want to wait to see the outcomes of those trade agreements and, of course, the 90-day pause with China. Secondly, we'll get June quarter inflation data ahead of the August meeting, but not in time for July. And Governor Bullock today talked about the importance of that quarterly measure instead of the monthly CPI measure. And we think when they get that quarterly, they'll have a bit more confidence that inflation is moving in the right direction, opening the door for a rate cut in August. And then we think a series of rate cuts taking the cash rate ultimately to 3% in early to mid-2026.
OK. And so you're expecting, if I could summarise, one more rate cut this year and possibly two more next?
We've got one more rate cut this year in August. We are open to the idea that RBA could cut again in November. That'll depend on both the evolution of those domestic risks and also what we're seeing for the household in Australia and also the labour market in Australia. Really, it's a question of timing and speed. We do think ultimately rates get down to that 3% level.
Jo Masters, great to speak to you.
Thanks.